Now we feature a presentation from iSectors. iSectors has become extremely popular on the Classic Plus FlexUMA platform. Today's speaker has worked in the business, holding various roles for the last 20 years. Please welcome Chief Operating Officer and Chief Investment Officer, Chuck Self.
Hello, I'm Chuck Self, the Chief Investment Officer of iSectors, talking to you from Appleton, Wisconsin. I wish I was in Nashville, where we were supposed to be this year, but Appleton is a nice place in the fall. Our trees are starting to turn before the winter snow. So hopefully, when you see this, it hasn't yet snowed in Appleton. But today, I want to talk to you about properly diversifying your clients' portfolios in this very challenging environment. A lot has changed over the past couple of years, and it's likely that clients' portfolio should be looked at as far as the diversification is concerned. And what the problem is, even coming into this year, is that most clients' portfolios are under-diversified. And it's not that you've done anything wrong, but it's natural when you have a 10-year bull market that over time, equity allocations creep up, people get more, they feel good about owning equities. And so, it's not really that uncommon to have too much equity in clients' portfolios. So even if you did diversify, you probably diversified to something close to a 60-40, 60% stock, 40% bond portfolio. And now, with the low interest rates we have, that may not be the right way to go. So what you probably need to do is diversify your diversifiers and add additional asset classes to clients' portfolios. And we have a way of doing it no matter the size of the portfolios. They don't have to be very large portfolios and still add this additional diversification. So if 40 years ago I told you you were going to earn 9% per year on average over the next 40 years by investing 100% in stocks, most of you would have said, yeah, I'm happy with that. The problem is, and especially for your clients, is the volatility along the way. As you can see in the gray bars, the amount you would have earned in each individual year varies tremendously from negative 30% in 2008, as many of you experienced, up to 34% in 1995. And so you have to be able to live with that kind of variance in return. Probably more importantly are the red dots on this chart, which shows you the most that the market declined in that year. And so you'll see that there are 8 places where 20% or more declines occurred in that year. In essence, you're in a bear market in those 8 years. And on average, the drop is 14%. So on average, you would have experienced a correction, which is usually defined as drops of 10% or more. And you look at years like 1987, where it didn't look too bad as far as having a 2% return, but you experienced a 34% drop that year. And many of you will remember October 19th of that year when the market had a big decline. So most clients cannot take the volatility of having 100% of their investments put into stocks, which is why you then diversified with bonds. And bonds have been a great diversifier historically. Over this 60-year period of time, if you just put your clients in 10-year treasuries, they would have earned about 6% on average over the 10-year period of time. And inflation was on average less than 4%, so you would have been ahead on an inflation-adjusted basis. And so it was a great diversifier. But look at it now. 10-year treasuries are under 70 basis points, while inflation is still between 1.5% and 2%. So you're actually falling behind owning treasury bonds. You have to take more risk into corporates, high yields, mortgages, international, in order to even keep up with inflation. So again, bonds are not as great of diversifiers as they used to be, and so maybe it's time to diversify the diversifiers. So this study shows for different types of allocations what you get if you add alternatives to your clients' portfolios. I've circled the place where it was 60% stocks, 40% bonds, and they show that if you change that to 50% stocks, 35% bonds, and 15% alternatives over time, you not only reduce risk, which is what the horizontal axis measures, but you also increase returns, which is what the vertical axis measures. So it really is worthwhile to consider alternatives for clients' portfolios. What are alternatives? You're probably aware of them, but this is how they differentiate compared to traditional investments. They have low correlation to the traditional investments such as stocks and bonds. And by low correlation, that means that they move in different ways than stocks and bonds. And because of that, the whole portfolio gets diversified if you include them in the portfolio. So if things work out well, like that chart you saw previously, you'll be able to have higher return and actually less volatility, less risk. The other advantage of having alternatives is that these are parts of the investment world where there are not a large number of people relative to the size of the investor market. And so there are inefficiencies in these type of assets such that you could earn more return than you should given the risk. And that's called alpha, if you're positive alpha, if you're able to do that. And often there's positive alpha in the alternative part of the market. So traditionally, we've thought about alternatives as private investments, ones that are not listed on exchanges, and they would include hedge funds, real estate, private equities, and commodities. But there's a problem with private alternatives. They can't fit everybody or shouldn't fit everybody. First, you have to be an institutional investor or accredited investor, and there's certain wealth and income minimums that your client has to have in order to be in private alternatives. And often the minimum investment is very large. If the minimum investment is $100,000, then many of your clients certainly can't, and you want a 15% allocation, many of your clients won't be able to invest in that alternative. Next is the lack of transparency. Once you give the money to the sponsor of the fund, they could do with it whatever they want. They don't have to show you or tell you, and you don't know where you really stand until the end of the fund when it closes down, which leads to the next problem, and that's illiquidity. If for some reason you needed that money for something, for some sort of emergency, for the most part you can't get it out right away. Even in hedge funds, which are a little bit more liquid, often you have to give notice, and you can only liquidate at the end of a quarter. And in bad times, you might not be able to do that because the sponsor can decide how much you could liquidate. But one of the worst parts of having private investments are the high fees. Usually, the sponsor charges 1% to 2% of the assets under management as their fee, and takes 10, 15, 20% of the profits also. So the fund has to do very well for you to do well at all. And then the biggest headache is the tax reporting. These funds are usually set up as partnerships, so they're taxed as partnerships. And when they're taxed as partnerships, you get what's called a K-1, which is a big, thick document of what has to be filed with the IRS. Your tax person will end up charging you more because they'll have to spend more time completing your tax return. So we know the three people who will benefit: the sponsors of the fund, the advisors like you who may get paid for selling the fund, and the tax preparers at the end of the year. But the largest problem has been the growth of these assets. Private equity has grown almost 3 times over the past 10 years, as shown in this graph, and even hedge funds have almost doubled in size. So you've got all this extra money with pretty much the same number of opportunities. This has led to lower returns in these asset classes, and also less diversification, because especially when you come to hedge funds, they end up investing like anybody else because they have to invest the money. So 20, 30 years ago, you could have maybe a 0.6 correlation to a moderate portfolio by owning hedge funds, and now it's a 90% diversification. So you're paying big fees and not getting diversification that you want. So we recommend that advisors consider liquid alternatives for their clients' portfolios. Some of the great things about liquid alternatives is that all investors could use them. There are no minimums as far as income or asset level in order to buy them. They're usually structured as mutual funds or exchange traded funds or ETFs, so they have great liquidity. Certainly at the end of the day, when it comes to mutual funds, you could sell. You could buy one share of the fund. You don't have to have large amounts of money. And because we're going to fractionalization of shares, it's really getting down to a point where you can only have to spend $1 in order to invest in these liquid alternatives. There's a regular disclosure of holdings in these funds. The mutual funds, they have to disclose quarterly. In ETFs, they have to disclose daily. So you pretty much always know how those funds are being invested. And then one of the best parts of it is that the fees are much lower than in private alternatives. Usually there's not a fee taken for a percentage of profits, and the fee on AUM is often under 1%, and some funds are down to 15 to 20 basis points. And then your tax guy is not going to work any more hours than he would regularly because he'll get the regular Form 1099 like you would get on any security that they own, and so there's no complication there. And finally, the real secret is that many of them have outperformed privates. But sometimes when we talk about liquid alternatives, people say, yeah, but there's good things about private alternatives. You can invest earlier in a company's life. And if you do that, you may receive higher returns. And we have all these tech companies where that has, millionaires and billionaires have been made from the profits of these kind of funds. And then the view that higher quality managers migrate to private alternatives because they know they can make more money off of what they do. Well, the reality is that yes, you can invest earlier in deals and in companies in their lives, but that doesn't mean you're going to make money for sure. That means you have a greater chance for losses also. So the question would be, will your gains offset all the losses you're going to incur? And you don't know you're going to get higher returns because the volatility of returns amongst the managers is huge. There are some managers that consistently do very well, and there's other managers that don't do that well. So it really is manager dependent, and it's very difficult to diversify against manager unless you have very large portfolios. And then the final point is that there's no test to take to be able to sell and manage private alternative investments. So you really don't know if the best managers are trying to raise funds in a private alternative. Maybe they think that they're good, but that may not be the reality. So we have 4 easy ways to start you in the liquid alternatives for your clients, and I'm going to spend some time discussing the ways that iSectors can help you. The first one is our sector allocation strategy, and it's our premier strategies that we've had for 15 years, so you have the ability to see how it's worked in many different market environments. The other strategies have been around at least 10 years, and they include a broad liquid alternatives strategy, inflation protection model, and then a unique diversified precious metal strategy. And so first I'm going to talk about our iSectors post-MPT strategy. The number one thing you want to do for your clients is to keep them invested. Now in bull markets that's no problem, but in markets like we've had over the past 9 months, it's sometimes problematic, and you may have gotten calls from clients that said, can I sell out? I just can't take it anymore. Well, that is the absolute worst call or text or however you get it from your client that you can get, because it's likely that they're going to be selling somewhere close to the bottom of the move. You won't get them reinvested until the market is much higher. And then somehow or another, you're going to get blamed for that. So the last thing you want to do is to have such negative returns that clients want to get out. And so the post-MPT strategy addresses that. It's 100% objective in that it doesn't matter how Chuck Self feels on any given day. All of our investment wisdom has been put into creating the model, and now we just take the model's output and apply it to clients' accounts. The objective is not to outperform a benchmark every quarter or year or month or anything like that. Our objective is to minimize downside risk. Again, if we can minimize downside risk, then when the market goes up, it'll take care of itself, and over the long run, as you can see on the right-hand side, you can outperform the market. We allocate to 9 low-correlated asset classes. 7 of them are sectors in the S&P 500, but we've added long-term treasury bonds and gold mining stocks. So again, you can get a very diversified portfolio doing this. We have proprietary factors, both economic and market-based, that determines how we allocate, and that's good because many of our competitors may have only 1 or 2. They may be just doing trend following or looking at volatility. Well, we're looking at a large number of factors so that if one goes astray, we still have the other factors working for us. And then you can see the outperformance over time, both on an absolute and risk-return basis. So although this is not a liquid alternative asset, it's a liquid alternative way of managing money. So this is a chart of the rolling 4-year periods over the last 15 years that the strategy has been in place. And what we've done is looked at, in red, what percentage of the time have the rolling 4-year periods been negative for the Standard & Poor's 500 versus in blue for the iSectors post-MPT growth strategy. So as you see, almost a quarter of the time, the S&P 500 has had negative 4-year periods since February of 2005, whereas post-MPT has had negative periods less than 1% of the time. So that shows that the strategy, even through all the crazy markets that we've had, is doing what it says it does. And the secret is shown in the next chart, in that these are rolling 12-month periods of time. In red is the Standard & Poor's 500 returns in rolling 12-month periods over the past 15 years, and blue is the post-MPT growth. If you start on the right-hand side, this is when the S&P 500 is in double-digit returns. And on average, we have not kept up in those markets, but we get about 70-75% of the gains when the S&P 500 is rocketing up. When it's in single digits, between 0 and 10%, we've outperformed about 2/3 of the time, and the clients like that. But more important is the far left-hand side, when the S&P 500 is negative. Then you could see that post-MPT growth has outperformed almost 90% of the time, and on average has only captured about 40% of the loss. So if you have a 30% down market and you've averaged about 12% down, you're not likely to get calls from many people saying, I can't take it anymore. In fact, they might be happy that you have put them in an investment that guarded them from the big loss. So the second liquid alternative we have is called our liquid alternative strategy, and it provides broad diversification amongst asset classes that are considered to be the typical alternatives classes: real estate, hedge strategies, what we call alternative equity, alternative fixed income strategies, strategies that have low correlations to the standard benchmarks in those capital classes. And one of the things that's important is that not only do you get that broad diversification, but you get exposure to these inefficiencies we talked about earlier, where you can earn higher return for the risk you're taking over time. And unlike the private funds we talked about before, the cost is much lower. We don't have any sort of fee to try to get a percentage of the profits that are made on the accounts. And in this particular strategy, our average fees are between 75 and 80 basis points. So under 100 basis points, and it has over time giving you better risk-adjusted returns versus the benchmark. And you can see both the absolute and Sharpe ratios. You might also notice that the yield currently is above 3%, which is attractive just in that, and in that you have probably a more diversified way of earning 3% than you would in the bond market right now. Our third strategy is our inflation protection strategy. It's kind of a sub-strategy of our broader liquid alternative strategy, in that here we invest only in classes that do well in times of inflation. We don't know when inflation is going to come back, but at some point it is, and when it does, it'd be great to have this kind of model in client portfolios. 25% of it are actually in Treasury inflation protected securities, or TIPS, and then the rest are in commodities, real estate, precious metals, and other asset classes that do well in times of inflation. Again, and you can see this on the right-hand side of this chart, the correlations to stocks and bonds are low to moderate, so it provides tremendous diversification. And we think that inflation has a risk coming back, given all the debt that is being taken on. And so, but even in the meantime, you're getting better returns historically than the HFRX index, which is a broad hedge fund index. So our investors have been happy to be in this strategy. Finally, the precious metals strategy is unique to iSectors. There is no other ETF strategist out there that has this strategy, which is a diversified group, optimally diversified group of precious metal bullion funds. We have gold, silver, platinum, and palladium in there. And we have created this fund to be the most tax efficient that it can be. And I'm happy to talk to anyone about that. It's a long discussion, but it's important to make it tax efficient. As you can see on the right-hand side, this idea, this model, has the lowest correlations to stocks and bonds, so you can get the greatest diversification by using just a little bit of precious metals. Even 10% will help the risk return of most clients' portfolios. And it will protect against inflation because they're hard metals in them. And as again, like in inflation protection, you can see that over time it has outperformed the HFRX hedge fund index. So we invite you to be able to talk to us about your liquid alternative needs. iSectors is very different than other investment managers in that we don't have the end client or retail client, or whatever it is, as clients. We only have financial advisors as clients. So we're here to serve you. And it's really easy to get us to get in touch with us. You can go on the Centaurus website and see our strategies on the website. See more information that I was able to tell you today. And you could talk to your regional representative to learn more about us. And of course, we will also be happy to answer your questions directly. So we'll make it as easy as possible for you to invest in what we think are quality strategies. We have experience, over 40 years of experience in the alternative business, and so we have the ability to serve you. Thank you so much for spending the time with us today. We appreciate your interest in learning how to better diversify your clients' portfolios, and we're looking forward to working with you. Please, again, go online, give your regional representative a call, or contact Scott Jones or I, and we'll be happy to walk you through the steps to be able to improve the quality of your clients' portfolios.
Great presentation, Chuck. Liquidity seems to be on every client's mind in 2020. If you'd like to learn more about the products and services iSectors offers, please contact the Centaurus Wealth Management Department or visit Chuck's profile on your conference agenda.